afternoon. My name is Scott Richter. I'm on the board of the MTA, and I have the distinct privilege of introducing and discussing alternative investments, Kaya, and the MTA with Keith Black. And let me just read this, Keith, so I don't make a mistake on it. CFA, PhD, CAIA, and you're the Managing Director of Curriculum and Exams for Kaya.
That's right.
Great. Welcome.
Thank you.
Thanks for being here. Could you address quickly, and I know you did this in your presentation, investor, especially institutional investor preferences for alternative investments and kind of what's driving that?
Right. So we're looking in alternative investments for something different. Mm-hmm. What we see is that in the stock and bond world, there's not a lot of opportunity for diversification. Clearly, stocks diversify bonds, but stocks around the world and bonds around the world are highly correlated. So we're looking for assets that are going to have less correlation or assets that are going to have higher return, right? So it makes sense to us that private equity over the long run would have a higher return than public equity, right? Sure. Because no one would invest for a 10-year lockup if it had a lower return than public equity.
One would think.
Right. We also think, let's find something that's different. So commodities have a completely different risk-return profile than stocks and bonds. So if we add those into our portfolio, that brings diversification as well. And there's a number of hedge fund strategies that could also bring diversification.
Okay. So let me clarify one thing. We're talking very much at an asset class and portfolio level as opposed to an individual security level in this strategy.
That's right. And so the Kaya program discusses private equity and venture capital, hedge funds and managed futures, commodities, and then the whole real asset space of real estate, timberland, farmland, infrastructure. Everything we do is at the index level, so benchmarks of manager universes. But a lot of those managers will have security-specific attributes within them, security-specific holdings.
Okay, great. Talk for a little bit about, in your presentation you talked a little bit about liquid versus more illiquid alternative investments and how technical analysis might have a role in helping manage those assets. Could you embellish that a little bit?
Right. So if we look at real estate, if we look at private equity or timberland or farmland or infrastructure, the way those funds are built is as a 10-year limited partnership. So you invest now, and 10 years from now, you'll get your money back when they sell the buildings and sell the holdings in those different companies. And so they don't have a daily mark-to-market process. They don't have quarterly liquidity. And so what happens is we'll do an annual appraisal of our properties, right? Or we'll only write up the value of a venture capital holding when the Series B or the Series C round comes. So you could hold these assets for a year at the same valuation, right? So it looks like a zero correlation, it looks like a zero volatility, but you know it's a portfolio of risky assets. And so because you can't trade it daily and because it's not priced daily, because this appraisal process kind of obscures the volatility, it doesn't make a lot of sense for us to be in and out of these assets and analyzing them on a technical basis. Right? But the core holdings of a lot of alternative investments are stocks and bonds and futures. And if stocks and bonds and futures are marked on a daily basis, and the manager has an opportunity to trade these daily, and you might have an opportunity at the end of the month or the end of the quarter to redeem from those funds, then technical analysis can add a lot of value.
Okay, great. How about talking a little bit about, let's shift gears and talk a little bit about the affiliation, the relationship that the MTA is building with Kaya, some of the joint events, and let me get your perspective on that relationship and its evolution.
So we're certainly excited to work with the MTA, and we have a lot of members in common as well. And so a key part of the Kaya program is hedge funds and managed futures. And at its heart, the managed future space is trend following and technical analysis, right? And so clearly there's a lot of people who've earned the CMT credential, who are in the managed future space, who also have the Kaya credential. And so our CEO likes to speak of the broad tent, right? And we're certainly willing and excited to work with people, who don't have the Kaya designation yet, right? But may be interested in doing that going forward. And so it's great to have an invitation to meet with your people, see who the joint members are, and to have an opportunity to meet your members as well and tell them more about Kaya.
Introduce each back and forth. Now let me ask you one other question. This is the famous, if you could give somebody one piece of advice, about moving forward in the alternative space, aside from getting the Kaya credential or the MTA CMT credential. What would you suggest somebody do if they really wanted to make a career in this space?
Certainly, you said after the Kaya, a lot of it's networking, right?
Okay.
Come to the MTA convention, come to the Kaya local
Meet and
events
greet.
that we have in the 20 chapters. Get out there and meet people. So I entered this space, maybe as a trader 25 years ago, but maybe as a consultant just 5 or 10 years ago. So working for a pension plan, working for a consulting firm where you have access to a lot of the managers is a really interesting way to go, right? Not a lot of people, graduate from college and go straight to a hedge fund. Right. You kind of need to go through a prop shop. You need to go through a bank, through a training program. And same thing works with the hedge fund space. So, get trading experience at a bank or a prop shop. Go to a consulting firm. Go to a pension fund where they manage and analyze these assets. Meet a lot of managers. Meet a lot of people.
Okay, that's good advice. And you don't see, as far as the runway, you think the runway is pretty wide open for the industry on the alternative side.
Well, we've gone from $5 trillion to $12 trillion in assets in just 12 years. And there's over $1 trillion in assets today in commodities, infrastructure, timberland, and farmland that we couldn't even count 10 or 12 years ago. And now there's liquid alternatives. And so we've seen $600 billion flow into this mutual fund space, both in 40 Act and UCITS. That used to be hedge funds or commodity funds, now they're mutual funds. And that's $600 billion in flows. And so now the flows into this liquid alt space are competitive with the flows into long-only stock and bond funds, and competitive with the flows into limited partnerships of hedge funds and private equity. And so the vehicles are changing, but there's still a definite momentum into raising assets in this alternative investment space.
And once again, this helps in the portfolio. It might not raise the expected returns, but it clearly helps manage risk.
That's right. And so now that we have mutual funds available in managed futures and long-short equity and fund of funds and commodities and REITs, they're in volatility products, there's a lot of opportunity to diversify your portfolio. So especially now, right, when we're at all-time highs in stocks and bonds, right, now's a great time to say, what's different?
What's different?
Right, because if you think that valuations on stocks are stretched, if you think that valuations on bonds are stretched, there's a lot of things you could diversify into that aren't stocks and bonds that hopefully would have a different reaction if and when those markets go into decline.
In the portfolio. Well, the future looks bright.
It does.
Keith, thanks so much for your time today, and thanks for speaking at the symposium.
Thanks for inviting us.